Hello, I'm Dieter Scherer, fee-only financial planner and founder of RealizeYourRetirement.com. This video is part of a series called Foundational Finance, where we'll go over the basics you need to know to get up and running in investing and begin to speak the language of finance. Foundational Finance is a part of Retirement Planning Academy, a free course I offer on RealizeYourRetirement.com. Today's video covers stocks, what they are, how they provide returns to investors, and how people commonly invest in them. A stock entitles the owner of the stock to a share in the current and future earnings of a company, which is why one item of stock is called a share. Owners of stocks are known as shareholders. Stocks are also known as equities. Those of us in finance will interchangeably use the two terms, which can be confusing, so just know they mean the exact same thing. Now, because stocks represent a share in the current and future earnings of a company, their value is determined by the success of the company. They don't really offer any contractual payments or protections for a return on your investment. So, with that in mind, the goal of a public company should be to maximize the investment returns of its shareholders. Unfortunately, it doesn't always work out that way in reality, but in an ideal world, management's interest should align 100% with the interest of shareholders. Here's how a shareholder's returns would work. Now, stocks can yield a return on your investment via two mechanisms: price appreciation or dividends. In this example, we're going to focus on price appreciation. And in this case, the price of our stock increases from $25 to $30. To calculate our return, we'll take the ending price of $30, subtract out the original price of $25, and divide the entire thing by the original price. So 30 minus 25 equals $5. $5 divided by $25 is 20%. So the investor's return would be 20%. Now, there's another piece that we're about to cover, dividends, and we'll see how adding dividends into the equation affects our investors' return. First, let's cover what a dividend is. Companies generally have two options: either reinvest earnings into the company via things like research and development, marketing, and acquiring other companies to expand into new markets, or if companies see only a small return on investment for internal projects like the ones I just mentioned, companies will instead issue dividends, when dividends could provide more value to shareholders by paying them cash. So a dividend is a cash payment from the company to shareholders. And dividends are completely optional. Many companies never issue dividends because they believe they can achieve higher returns by reinvesting their cash internally. In this example, the price of the stock once again increases from $25 to $30, but this time there's also a $2 dividend. So $30 minus $25 equals $5. $5 plus $2 equals $7. And finally, $7 divided by 25 gives us an investor return of 28% with the dividend. As you can see, the dividend offered a higher rate of return over the price appreciation calculation alone, which we covered in the last slide. And if you look at the stock market over the last 100 years, you'll see that dividends often make up a large portion of the total return an investor receives from a company. So it's important to understand how they interact with investor returns. So, how do you invest in stocks? Well, stocks are traded on stock exchanges such as the New York Stock Exchange and the NASDAQ. On exchanges, stocks can be purchased for individual companies. Stocks can also be purchased in groups via mutual funds or exchange-traded funds, commonly called ETFs. Mutual funds and ETFs will either buy stocks based on certain criteria they have set themselves, or they buy stocks based on whether they are in an index. For example, the widely reported S&P 500 index tracks the largest 500 stocks by total market value in the United States. The Dow Jones Industrial Average tracks the 30 stocks deemed to best represent the major industries in the United States. When people refer to what the U.S. market is doing, they're usually referring to one of those widely followed indexes. Another widely followed index is the MSCI EAFE, which tracks large companies in developed countries such as Europe, Asia, and the Far East. So, an S&P 500 index fund would simply hold the same stocks that are in the S&P 500 index, whereas other funds may choose specific criteria when selecting stocks in an effort to either reduce risk and increase returns. Now, another important thing to cover is bankruptcy. In the event of a liquidation bankruptcy, the company's assets are all sold and used to pay the claims of lenders and shareholders. And they're usually paid in this order. The first paid are the debt holders, such as those who have bought bonds. They're paid as much of the balance of the debt as they are owed, as well as any interest that they are owed. Next, if there are any funds left over, holders of preferred stock are paid their dividends. And finally, common stockholders are paid out whatever remains. When you buy a stock, you generally buy a common share of stock. And because common stock shareholders are the last on the list to receive any money in the event of the liquidation of a company, they bear the most risk. However, they also receive the greatest reward if a company does well. Bondholders and preferred stock owners are only paid interest or dividends in set amounts, but they don't have a share in the future profits of the company. Common stockholders are offered the greatest upside potential, but because they're last on the list, they also have the greatest downside potential. If you'd like to learn more about the basics of finance, watch these other videos in the Foundational Finance series. And if you want to learn more about investing, sign up for my free course, Retirement Planning Academy, by visiting realizeyourretirement.com. Inside, we'll discuss how annuities actually work, how value investing and tactical asset allocation can help you reduce risk and increase potential returns, how to maximize your Social Security, and how to make smarter retirement planning choices. And you'll get access to exclusive tools and calculators that I've built just for members. To sign up for this free course, just go to realizeyourretirement.com. Thanks for watching today, and I hope to see you soon.